Good afternoon. This video will go through stock diversification using the M1 tool, but there will be a methodic approach to this that could help you in your investment strategy. For this exercise, we're going to use the screen tool from the TD Ameritrade portal with the following metrics. We're going to have the ROE of 20 or more. We're going to have a price to earning between 20 and 40. The capitalization is going to be a mid-cap capitalization. We're going to use E-Trade to verify earnings, debt to assets, income, and balance statements. We're also going to use Robinhood to verify the return in the last 5 years. For this exercise, we only want returns of 200% or greater in the last 5 years. And then we're going to use the M1 financial tool to make a quasi ETF in a pie, kind of like a pie. They call it a pie that you can invest whatever you need to. You can invest $50, you can invest $1,000. So it's almost like lets you leverage compounding and fractional investment as well. All right, so I am going to, like I said earlier, the first thing I'm going to do is I am going to use the screen tool in Ameritrade. And if you don't know how to do this, please look at my last video. It's essentially you just go into research and ideas, and you click screeners and then stocks, and you get to this page here. Okay, so the next thing I'm going to do is I am going to create a screen. And I showed you how to do this in the last video. And I'm going to use the data set that we had on the slide set that I used when we earlier on when I was presenting this topic. So I'm going to go into the fundamentals, and I am going to use a return on equity of more than 20, like I stated earlier. So I'm just going to click 20 to 30. So more than 20 and 30 and above. The next thing I want to do is I want to have a price to earning of about 20, between 20 and 40, because you don't want to pay too much for a stock. You don't want it to be overvalued, obviously. So I'm going to go to valuation, and I'm going to see here price to earnings. Actually, I want the P/E ratio, not the growth. So I want the TTM, the last 12 years. So the price to earnings, I'm going to pick between 20 and 50. So that's kind of in the ballpark over there. So that makes sense. So the average is about 25.7. Okay. And then, so now we have 246 companies. I'm going to make that even smaller by changing the capitalization. And that's right there. And you click market capitalization. And I am going to get a mid cap. So now we have 50 companies to look at. Now, like I discussed in the previous video, if you want, you can reduce it to the types of exchanges. Actually, maybe I'll do that. Cause I don't want OTC, over the counter. They're good, but the platforms that I'm using can't really trade OTC. So let me see if I can do that. So I'm going to pick all of these exchanges except OTCs. So let's see if it'll let me do that. Okay. All right. So now we reduce that to 35 matches. And I'm going to see what my matches are. All right. So continuing on, as you can see, here are our matches. So I'm just going to go through about 5 to 6 of them, and I will see just verify if the earnings make sense. B, I'm also going to verify, their debt, income statement, and balance statement. And then I'm also going to verify with Robinhood, kind of like the trend within the last 5 years. Like we said earlier, we want 200% or more. And I'm actually going to open Excel, and I will start populating some of the stocks that I think make sense before I put into my pie. All right. So let's start here with All right, so let's start here with this company called NSP, um, Professional Services. Um, it's not my favorite industry, but I'm just going to go to give it the benefit of the doubt. And let's see here, NSP. See where they've been in the last 5 years. Look decent. You know, they probably were hit by the coronavirus at this valley point right here. And then I'm going to look at the fundamentals real quick. I'm going to make this really quick. The first thing I want to see, I want to look at their debt, the debt to asset. Uh, it's kind of high for this industry, but it's not too bad. Obviously, you can see they've been more aggressive than most of the people in the same industry. Obviously, we're expecting a really high price to earning, a really high, that's really high price to earning. Their P&E is not too expensive, so it's not overvalued. So, all right, so I'm just going to run through the balance sheet real quick. The assets, total assets has been growing. You can see that it's been going in the positive direction. Liability, we just want it to be a little bit flat with not too much variations. So I'm going to look at the total liabilities, which is the liabilities are kind of increasing, but I'm not sure how that works in that industry. Maybe that's what they need, but it's not a showstopper yet. Anyway, the income statement. Look at the revenue. The revenue seems to be growing. And then I am going to look at the net income right here. And the net income seems to be going the positive direction. And then one thing I'm going to do before I leave is the earnings statement, is the earnings. And if you look at the earnings, it seems like their forecast for 2021 is lower, but obviously you guys know about the coronavirus, so that might be a new reason why this unusual, unexpected issue occurred. So I don't really see anything too bad as far as this company is concerned. And then I'm going to go here to see how they are in NSP the last 5 years. NSP. This is Robinhood, by the way. Just see 5 years. And in the last 5 years, they've made about 302%. So that's more than 200. So this is something that we want to at least consider. So I'm just going to pull up Excel, and I'm going to put NSP and the return 300. Okay. So let's go to the next guy, which is NRC. This is healthcare. So obviously, healthcare is something that you know we should probably invest in, only because the population keeps aging, and so this is one of the industries you kind of want to take a look at. So NRC, its return on equity is 87%. Let's go here and check out NRC. Oops. NRC. All right, the last 5 years, they seem to be going strong. They might have got a dip here. This is probably March of 20. Obviously, we know what happened then, and they seem to be on an upward trajectory. Real quick and dirty, let's see their earnings. Earnings seems to be going in the positive direction. I don't have anything for 2018. Let's see the fundamentals. Price to earnings, it's not too bad. It's more expensive than I would like, but it's not too bad. The return on equity, obviously, we know that's going to be high. The debt is still kind of high up there. Uh, you know, so they have a lot of debt, but it's not too bad. 25 points is not too bad, but the fact that they're more aggressive than their peers, raises our brow a little bit. And then the next thing, let's just run through the balance sheet real quick here, just real quick and dirty. As far as cash flow is concerned, their cash flow seems to be going down, But what we want to see is the total assets. So total assets seems to be going in a downward direction from what I can tell you here. Liability is second here. Liabilities, total liability is going up. So, if your asset is going down and your liability is going up, it might not be the best thing to invest in. And then let's see the income statement real quick here. So for the income statement, you want to see the net income. Here's the net income, and the net income seems to be doing decent. They had an extraordinary item here. Not sure what that is. I bet you they probably have one here too because of coronavirus, but it's still going up in the right direction. Now the next thing I want to just check it out on Robinhood just to see the trend, see if it meets our 200% threshold. And RC. And remember, it's just a quick and dirty way. You want to spend time to make sure that we dot your I's and cross your T's. So this has 252, which is good. It would have been more because, as you can see here, March 2020. This is when the coronavirus hit. It kind of took a dip here. So it took a dip of about, let's see, this is 338, and this is 171. So it took a dip about probably more than half of its value. So this can be an opportunity for growth in this area if things keep going in the right direction. So I'll add it to the list. It's not my favorite, but I'll add it to the list. So NRC 252. And then let's do a couple more. Let's see Crocs right here. Crocs is discretionary, textile, apparel, and luxury goods. So I am going to check out Crocs real quick here. Okay. And in the last 5 years, they seem to be going good. Obviously, you can see the trend with the dip here in March. So I think it was really bad for stocks. Obviously, there's a correlation there. So let's see here. Let's look at the fundamentals real quick. The debt is not bad. It's better than what we've been seeing in the past. Price to earnings, beautiful price to earnings. Return on equity, 87.5%. I bet you if you look at the earnings before depreciation and amortization here, and the profit margin, I think this has a lot of good opportunities. But let me just check in Robinhood to see what the trend has been in the last 5 years. And I am going to go here and CROX. All right. In the last 5 years, they've had 500% the last 5 years. In the last year, 76%. In the last 3 months, 61%. In the last month, 15%. So this is this is a good opportunity here. I think, in my opinion, anyway. All right. So let's do one more, and so the video is not too long. Let me see. Let's try the next one here. This is meds, personal products, whatever. MED. Let's go here to E-Trade. MED. And right here. All right, let's see what they've in the last 5 years. They were going up here. Now I don't know why they dropped in early 19. I know this part right here, but it seems to be going back and up. Price to earning is really cheap. I would do my research on this stock before I buy it. And then let's see the fundamentals. What I mean by research is that you want to see how the insider trading is working. Like if people are buying, there's some intangibles that we're not sure about. You want to make sure you look into that. But the debt they're reporting really low debt here. Obviously, we know what we expect from the price to earnings and the price and equity because we queried that. The company is here in the United States. It's in Maryland. Let's see what the balance sheet looks like. They have decent amount of cash. Total asset is going up in the right direction, and then hopefully liability is flat, or at least not. See, liability is not going. It's not too bad. Sorry, I'm sorry. You want total liability? I'm sorry, that's the wrong. Total liability is it was flat and it kind of went up a little bit here, but it's not too bad. This is not too bad. What you don't want is your assets going down, your liabilities going up. That doesn't make any sense. So you go to your income statement. Revenue is going up. That's good. Let's look at your net income. Your net income is going up in the right direction, at least in the last 4 years. Let's go to Robinhood and see what is going on with Med, if it meets our threshold of 200% or more. Med. All right. Well, as you can see here, they went up 488.78% in the last 5 years. I worry about this right here. What happened from 2018, you know, down to let's say around November of 2019. So this is about let's say 600, and this is so why do they have such a huge, like a 5 times drop? So they were up $248 here, and now they were down here $77. So that delta, you probably want to research that, but I'm not here to research. I'm not going to research that right now. But it could be a good opportunity. Something might have happened. Maybe they reversed a lot of their revenue. I'm not sure. But let's see. Let me try one last one and then we're going to wrap this up. So the next one I'm going to pick, let's see, I'm going to pick, let's try this guy here. Genetics, is Fulgent Genetics. Let's see here. FLGT, let's try here again. FLGT, okay. Okay, they're a relatively new company. Looks like they're going up in the right direction. Fundamentals. Debt seems low. That's what they're reporting anyway. Their gross profit is absolutely outstanding, and their return on equity is great. Is decent. Let's just see the balance. See, the balance statement and the income statement, the return on equity, like we talked about in class, kind of takes that into account anyway. But still, you still want to deep dive. Total assets going up in the right direction. Total liability going up definitely in the right direction. Now let's look at the income statement. Revenue going up, and let's see net income. Yeah, I don't know what's going on with that, but you probably want to research that, why that's going on. So I am not going to invest in that. So I think I'm just going to go with Med. So Med, and I don't remember how much of the percentage that was. Let's go back here. It was 488%. Okay, so I'm just trying to make this quick. So what I do now is I go to this site called M1 Financial, which is right here, and so M1 allows you to add all these stocks into a portfolio, and then you wrap it all together into one ETF. So let's add what we have so far. We have NSP, Okay, so we add that NSP, that right there, add to bucket, and then add. Okay, and then what's the other one? NRC. Okay, add NRC right there, and then you add that too. Add. And then you add, let's see, what's the third one? The third one is med. Okay. You add med, MED, add to basket, add. So essentially, I'm not going to say this part of it, but what I'm trying to do, essentially what you're going to do is you add all these stocks that you've done your research that you know has a good return on equity. You know it has a decent price to earning. You know in the last 5 years, each of these have had returns of at least 200% or more. You know that the debt is low. You know that they're mid-cap companies, so there's room to grow. So you've done your research. You've tried to mitigate your risk to the extent you can. Anything is possible, but there's a good chance that you should be profitable with this in your portfolio. And you can do one of these and equalize it the whole portfolio, or you can take a weight based on a percentage of the percentages it's giving you in the last 5 years. So what I mean is that is you take the 400% and the 300% or whatever, and you weigh them against 100% of your total portfolio, and then you put those percentages in these buckets as you wish. So that's all for that video. So once you put this together, that's one ETF. You can put $50 a month here. You can put $1,000 a month. And it will automatically invest. So you have that sense of compounding. So in this way you can buy Amazon if you want to for $50, like a fractional share, and still compound every month if you want to. So you can have a growth annuity for your returns. So thank you so much. I hope this helps. If you have any comments, please put it in the box. Thanks.